Two people with HVAC experience decide to start competing companies. Both need about $400,000. One gets approved for financing in a matter of weeks. The other spends months chasing lenders and still cannot close. The difference is not their credit score, their experience, or their down payment. It is what they decided to buy. Most buyers assume lenders are evaluating businesses. They are not. Lenders are evaluating predictability, and those are not the same thing. There are 5 questions every lender asks when they compare a franchise to an independent startup. This video walks through all 5 and explains exactly why the answers are not always what buyers expect. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Here's the situation most buyers walk into without realizing it. You have done your research, you know the industry, you have the experience, the cash, and the credit. You are comparing 2 paths. Start an independent business from scratch or buy into a franchise system. The numbers are close. The concept is the same. On paper, both paths look viable. What you probably have not thought about is that the lender sitting across from you is not reading the same spreadsheet you are. You are evaluating a business opportunity. The lender is evaluating a loan. Whether the business is a good idea is not the question they are trying to answer. Whether that loan gets repaid, even if things do not go according to plan, is the only question they are working through. That distinction shapes every conversation you will have with a lender, whether that is an SBA lender or a commercial bank. Buyers who understand that distinction before they walk in have a real advantage over those who figure it out after the deal is already in motion. The 5 questions lenders ask are the framework that makes that distinction concrete. The track record test, the operator test, the startup budget test, the support system test, the exit test. Question 1 is the track record test. The question a lender is really asking here is, has this business model already been proven somewhere else? Meet Pete. 10 years of HVAC experience, $100,000 in cash, and a decision to make. Path 1 is Pete's Heat and Air, an independent startup. Total project cost $400,000. Loan request $300,000. The budget looks reasonable. The projections look solid. But every single number in that projection is an assumption. How many customers will Pete have in month 3? How quickly does referral business develop in a new market? How much does it actually cost to build a customer base from zero? Nobody really knows, and that includes the lender. Path 2 is AirAce, an established HVAC franchise. Same Pete, same experience, same cash. Total project cost $450,000. Loan request $337,500. The budget is higher because of the franchise fee, required systems, and initial training. But the lender is now looking at something fundamentally different. Operating history from other AirAce franchisees, a documented training program, established vendor relationships, performance patterns from hundreds of other locations. The lender is not saying Pete's franchise will succeed. They are saying they have real information about what success and failure tend to look like in this system. That is a different conversation entirely. Question 2 is the operator test. The franchise helps, but Pete is still being evaluated. This is where some buyers make a costly assumption. They figure the brand name covers their qualification. It does not. Lenders still need to know whether the person borrowing the money can actually run the business. Industry experience, management background, creditworthiness, and the demonstrated ability to repay are all still on the table. The franchise fee does not buy Pete out of the operator test. What the franchise changes is what the lender evaluates about the system. What it does not change is what the lender evaluates about Pete. A buyer without relevant experience should not assume a strong franchise brand solves the qualification problem. Both are evaluated every time. Question 3 is the startup budget test. This is where the conversation moves from concept into money. Lenders are not reviewing a startup budget to see whether the numbers look optimistic. They are testing whether the cash flow after the business opens can actually support the debt payment. That is the calculation, and it does not bend for a confident projection. For Pete's independent startup, the budget is built on assumptions that cannot be verified in advance. Customer acquisition pace, marketing effectiveness, how long it takes for referrals to replace paid acquisition, how quickly revenue stabilizes. Each assumption layers risk onto the next, and the lender has to accept or reject all of it. For Pete's franchise, the budget includes costs that might look higher on the surface, the franchise fee, the required systems, the initial training. But each of those line items is documented. The lender knows what training costs, what the vendor relationships look like, what the typical ramp period is across the system. A budget built on documented costs is a more straightforward underwriting conversation than a budget built on assumptions, even when the franchise total is higher. The right question a buyer should be able to answer for either path is, what does year one look like if revenue comes in 30% below plan? If the answer requires a lot of optimism to hold together, the lender will notice before the buyer does. Question 4 is the support system test. This is why a more expensive franchise can still present better to a lender than a cheaper independent. The franchisor provides things an independent operator has to build from scratch. Documented training, established vendor pricing, brand recognition that generates calls before the doors open, operational systems that have been tested across hundreds of locations. From a lender's perspective, all of that compresses the uncertainty window in the first 12 to 18 months, and the first 12 to 18 months is when most of the risk in any startup is concentrated. Pete's independent startup requires him to build his customer base, his vendor relationships, his training process, and his operational systems simultaneously, while also generating enough revenue to make the loan payment. That is not impossible. Independent HVAC businesses succeed every day, but it is a harder underwriting story than a buyer who walks in with a system already behind them. The support system advantage is not automatic. It depends on the strength and stability of the franchisor. Not every franchise system delivers equal value, but a well-documented support structure changes what a lender is looking at when they assess early-stage execution risk, and that changes the approval conversation. Question 5 is the exit test. This is the one most buyers have never thought about because it requires thinking about failure before the business has even opened. Entrepreneurs plan for success. Lenders underwrite for failure. The exit test is the lender asking, if this does not go according to plan, what is the path forward? If revenue comes in soft in year one, if the operator gets sick, if the business needs to change hands before it fully matures, how does this loan get repaid? Can the business survive a disruption, or does everything depend on one person executing perfectly from day one? A franchise in an established system offers a more defined answer to those questions. The business can continue operating under a different operator because the systems, training, and brand do not live inside Pete's head. A new operator can step into a documented process. A lender can underwrite continuity. For an independent startup, those answers are much harder. The business is whatever Pete built it to be, and without him, there may not be much of a business left to recover against. That asymmetry matters to lenders. The question is not just whether the business will succeed, it is whether the loan can survive a scenario where success does not come as planned. Here's what this video comes down to. Lenders are not comparing whether a franchise or an independent is a better business. They are comparing which one gives them a clearer picture of what happens after the loan closes. A franchise brand does not replace the buyer's qualification. Experience, creditworthiness, and the ability to repay are all still evaluated regardless of what flag is on the building. An independent startup budget built on assumptions is a harder underwriting conversation than a franchise budget with documented cost categories even when the franchise costs more upfront. The franchisor's support system, training, vendors, brand, and operations reduces lender uncertainty in the first 12 to 18 months in ways an independent operator has to build from scratch and on the clock. Entrepreneurs plan for success. Lenders underwrite for failure. A buyer who understands that distinction walks into the financing conversation with a real advantage. Before you decide whether the franchise fee is worth it, decide whether you are pricing the full value of the system because the lender already is. If this helped you think through the financing side of this decision, subscribe. There is more coming on how lenders actually evaluate small business deals. And it is the kind of information most buyers only find out after the fact. Research the deal before you fund the deal.